Nvidia's market capitalization recently crossed $2 trillion. Germany's entire stock market, every publicly traded company in the fourth largest economy on earth, is worth less. That fact is circulating right now as a symbol of American technological dominance. The way it gets used, the way it gets shared, the way financial media frames it is almost uniformly celebratory. A number that large, growing that fast, means the future is being built and you are watching it happen. The data tells a different story. The pension fund manager running a target date fund cannot easily see what is inside that number. Neither can you if your retirement savings sit in a broad market index. What that number represents is not just a bet on artificial intelligence, it is a concentration of systemic dependency that every investor in the American market is now carrying, whether they chose to or not. The structure made that choice. You were not asked. This is not the first time a single company absorbed the weight of an entire technology cycle. In the year 2000, a company called Cisco Systems held a market capitalization of $550 billion, making it briefly the most valuable company in the world. Every network that would carry the internet ran through Cisco hardware. Every analyst said the growth was justified. Every investor who held an index fund owned more Cisco than they knew. 3 years later, Cisco had lost 80% of its value. The business survived, the valuation did not. The mechanism running underneath Nvidia's valuation right now is the same one that ran underneath Cisco's in 2000. Not the same technology, the same structure. Think of a single mountain pass that every road in a region must use. It does not matter how many trucks are moving, how much freight they carry, or how many companies depend on the route. If the pass closes, the entire region stops. The mountain pass is not the destination, it is the choke point. Nvidia is not artificial intelligence. Nvidia is the choke point that every major artificial intelligence system currently runs through. The difference matters. The mechanism works in 3 steps. First, a new technology creates massive demand for one specific input. Second, that input becomes so embedded in the infrastructure of the technology that switching away from it becomes structurally expensive, not just financially. Third, the market prices the company controlling that input as if the demand is permanent, the moat is unbreachable, and no alternative will arrive in time to matter. Every dollar flowing into artificial intelligence, from hyperscaler data centers to enterprise software to government compute contracts, passes through Nvidia's graphics processing units and the software stack that runs on them. Approximately 70 to 90% of the chips powering large AI model training today come from one company. That is not a market share number, that is a choke point number. Here is the specific weight of it. Nvidia represents more than 6% of the S&P 500 index by weight as of early 2025. A broad market index fund tracking that index does not give you diversified exposure to the American economy. It gives you 6 cents of every dollar in Nvidia before you have bought anything else. If you hold a target date retirement fund, a standard 401k index allocation, or a broad ETF through any major brokerage, you are holding Nvidia concentration you may never have actively chosen. The structure chose it for you. In the spring of 2000, Cisco Systems was worth more than any company in history. The internet was real. The growth was real. The infrastructure build-out was real. Every major corporation on earth was wiring itself for the digital economy, and Cisco made the equipment that made that possible. Analysts at every major bank had price targets that assumed the growth rate of the late 1990s would continue for another decade. The surface narrative was logical. The internet is not going away, and the company that builds its backbone will grow with it forever. What was actually happening underneath that narrative was a concentration spiral. Cisco's stock had become so large a component of index funds that institutional money was being forced into it with every new dollar that entered the market. Index rebalancing bought more Cisco. New index fund inflows bought more Cisco. The price rose, which increased the weighting, which forced more buying, which raised the price further. The valuation was feeding itself. Cisco's price-to-earnings ratio reached 189 times earnings at its peak. Not because the business was worth that, because the structure of passive investing had turned the stock into a self-reinforcing loop. The correction began in March of 2000. By October of 2002, Cisco had fallen from $80 per share to $8, 80% gone. $500 billion in market capitalization erased. The business kept running. Revenue held. Cisco still makes networking equipment today. But the investor who bought at the peak in 2000 waited 20 years to break even, not months, 20 years. The parallel is not perfect. Nvidia's actual earnings are real in a way Cisco's were not fully supported at peak. The artificial intelligence demand driving Nvidia's revenue is genuine. That honest acknowledgement does not dissolve the structural risk. It makes it harder to see. The asset is different. The concentration is the same. The person contributing to a standard index fund today is not making a bet on Nvidia. They are making a bet on the American economy, and the American economy's largest index weight is Nvidia. Those are not the same thing. The system did not ask whether they understood the difference. What the historical record tells us is not that Nvidia will follow Cisco's path on the same timeline or with the same severity. Patterns are not guarantees. The artificial intelligence cycle could sustain Nvidia's earnings in ways the internet build-out could not sustain Cisco's. That is possible. What the record does tell us is that when one company becomes the mandatory choke point for a technology cycle, the market prices that company as if the choke point is permanent. It never is. Right now, Nvidia's price-to-earnings ratio sits near 65 times forward earnings, not the 189 Cisco reached. But the direction is the same, and the mechanism driving it is the same. The higher that number climbs, the more the valuation depends not on what Nvidia earns today, but on the assumption that nothing changes the structure of AI infrastructure in the next 5 to 10 years. No competitor closes the gap. No customer builds around the dependency. No geopolitical event interrupts the supply chain. All of those assumptions must hold simultaneously. 6% of the S&P 500 is one company, one product cycle, one choke point. The question is not whether Nvidia is a great business. It is. The question is not whether artificial intelligence is a real technology. It is. The question is what you are actually looking at when you see a market capitalization larger than Germany's entire stock exchange and call it a measure of progress. The last people to know are always the ones who trusted the headline longest.